well. The biggest mistake they make is listening to a lot of other people. And
You're investing.
you should understand what you buy. Now, if you buy a farm, you look at the farm and you say, I expect to get so many bushels per acre.
Investing isn't just about picking stocks. It's a roller coaster ride where your emotions can steer you off track. It's thrilling, but if you're not careful, you might end up regretting it. Many investors get tangled up in fear and greed, but leading to some pretty big mistakes. If you know the common traps, you can keep your money safe and make smarter choices. Now, have you ever wondered why most traders end up losing money? Well, it's not because they forgot their lucky socks. Let's dive into the secrets of smart investing and discover how to dodge the pitfalls that even the pros stumble over. But before we jump in, make sure to like this video, hit subscribe, and ring that notification bell.
Welcome to Market Reflect,
Your go-to spot for all things smart money. The real game is all about what's happening inside your head and how you handle the chaos around you. Emotional decisions can silently undermine your portfolio. Ever felt like the market is whispering sweet nothings to your heart instead of your brain? Turns out, emotions, fear, greed, and everything in between are the sneaky culprits behind most investment failures. In fact, in one country, 7 out of 10 intraday traders in 2022-23 lost money. Why? Because emotions made them buy high and sell low. When the market dips, fear hits, and when it rallies, greed takes over. It's a roller coaster ride, but instead of enjoying it, people are tossing their savings like confetti. Now, smart investors, they let logic drive the car, while emotions sit quietly in the back seat, probably scrolling through social media. Mindset is everything. Adopt a long-term view and resist the urge to act on every market twitch. Your wallet will thank you. Skipping research often leads to costly mistakes. Think you can wing it because someone on social media says a stock is the next big thing? Think again. Many beginners treat stock prices like menu items. Cheaper seems better, right? Wrong. Penny stocks might look tempting, but they're often junk. Without solid research, you might as well be throwing darts blindfolded at a wall of stock tickers. And listen to this. Research isn't rocket science. Start small. Want to know how a company is doing? Read its annual report. This isn't boring paperwork. It's the company's life story, full of clues about its health, revenue, and future plans. Don't just follow influencers. Learn how to analyze fundamentals. It's like putting on your detective hat and Sherlock Holmesing your way to better investments. Overconcentration risks everything on one fragile basket. What happens when you bet everything on one horse in the race? It's not pretty, and the horse might just throw a shoe. Imagine pouring all your money into tech stocks during a boom. Then bam! The sector crashes and your portfolio goes down faster than a lead balloon. Ah! Diversification is your safety net. A balanced mix of 10 to 15 shares, some funds, and a sprinkle of bonds can do wonders. Even just splitting your money across a few different sectors or assets can significantly slash your risk. You know that? Don't chase the get-rich-quick stock that everyone is hyping. Spread the love and your investments. Chasing hype traps investors in herd mentality. Ever hear the phrase, if everyone's jumping off a cliff? Well, it applies to investing too. And trust me, you don't want to be the last one to hit the ground. Let's get real. Humans love a good bandwagon. But in investing, following the crowd often means you're late to the party. Remember Bitcoin's wild ride? By the time most people read about its meteoric rise, the smartest investors had already cashed out and were sipping cocktails on a beach somewhere. Here's the secret. Success comes when you zig while the crowd zags. Don't just look at what everyone else is doing. Focus on what's undervalued, not what's trending. Ignoring fundamentals results in poor risk management. And what's riskier than gambling? Investing without understanding risk. Talk about playing with fire. Risk isn't just a four-letter word. It's the price you pay for potential rewards. The problem? Most people don't even know how to measure it. High demand might make a stock look like a winner, but without strong fundamentals, profitability, revenue growth, and a solid business model, it's like building a house of cards in a windstorm. Learn to differentiate between high-growth stocks and value traps. And don't be afraid of risk. Manage it. Align it with your goals and tolerance, and you'll sleep better at night. No counting sheep required. Impatience undermines long-term financial success. Would you rather run a marathon or sprint a few feet and quit? You know what? The marathon is where the real rewards are. Most investors treat the stock market like a casino, hoping to double their money overnight. Here's the harsh truth. Wealth building takes time. Think of investing as planting a tree. You won't get shade the next day, but years later, you'll thank yourself for watering it consistently. Patience isn't just a virtue, it's a strategy. The best investors wait for the right opportunities and don't panic during market turbulence. Remember, time in the market beats timing the market every single time. Failing to review your portfolio risks falling behind. And what's worse than making a bad investment? Ignoring it and hoping it magically fixes itself. Spoiler alert, it won't. Life changes, and so should your portfolio. Whether you're saving for your dream home or preparing for retirement, regular reviews keep your investments aligned with your goals. It's like adjusting your sails to stay on course during a storm. Markets evolve too. Strategies that worked 5 years ago might not cut it today. Successful investors adapt, tweaking their portfolios to meet new challenges and seize opportunities. Overpaying for growth or chasing value traps harms returns. Think all shiny things are gold? Think again. Fast-growing companies often come with sky-high valuations. But if they can't meet market expectations, their stock prices tumble. On the flip side, cheap companies might be value traps, struggling businesses with no real upside. The trick? Find the sweet spot between growth and value. And when it comes to dividends, look for companies with sustainable payouts. A high dividend yield is worthless if the company can't afford to keep paying it. Ignoring the clock makes late starts costly. Ever hear about the magic of compounding? It's real, but only if you start early. Here's a mind-blowing stat. 100 pounds invested at 5% annual growth for 45 years grows to 898 pounds. But wait 10 years to start? That same 100 pounds grows to just 551 pounds. See the difference? Saving and investing early is like planting seeds in fertile soil. Even small contributions snowball over time. So if you're procrastinating, keep this in mind. The longer you wait, the harder it is to catch up. Now, over-investing in alternatives violates the 20% rule. Feel like Bitcoin or buy-to-let properties are your ticket to riches? Slow down. Sure, alternative investments can be thrilling, but they're also high risk. For example, cryptocurrencies are magnets for fraud. and most spread bettors lose money. Believe it or not, even real estate, with all its charm, comes with hidden headaches, maintenance, legalities, and market crashes. Experts suggest keeping no more than 20% of your portfolio in these risky assets. Stick to the classics, shares and bonds. They're boring, but they work. Most traders lose money, as stats consistently show. Let's look at the numbers.
We added nearly 6.5 crore new investors into the market. But the thing is that from 3 crores to 9.5 crores, that's what.
If you think that's bad, 89% of traders in the F&O segment, nearly 9 out of 10, lost an average of 1.1 lakh. Why? Lack of strategy, emotional decisions, and zero risk management. Trading is a tough game, and if you're not prepared, the market will chew you up and spit you out. Chasing headlines distracts from sound strategies. Remember when everyone thought the world was ending in March 2020? Guess what? It didn't. The FTSE All-Share fell by a third during the pandemic. But guess what? It bounced back. The lesson here? Short-term news cycles are noisy distractions. They make you panic when you should be staying the course. Instead of obsessing over global events, focus on the companies and funds you're invested in. Strong fundamentals matter more than headlines. Setbacks teach valuable lessons, not failures. What if I told you that failure is just feedback? Even the best investors have stumbled. The difference? They treat losses as lessons. Every setback is a chance to refine your strategy and become better. Think of it this way. Each mistake is a breadcrumb leading you towards smarter decisions. As long as you learn and adapt, you're still in the game. Seek help, but stay true to your financial goals. Sometimes you need a guide. But remember, not all advisors are created equal. Shop around, compare fees, and make sure they're worth the cost. And don't stop there. Educate yourself. Courses on topics like reading annual reports can turn you into a savvy investor. Knowledge is power, and in investing, it's your greatest weapon. So that's the playbook, folks. Investing isn't about luck or shortcuts. It's a craft. Nail the basics, keep your emotions in check, and always stay curious. What's your biggest challenge when it comes to investing? Fear? Greed? Or something else? Share your thoughts in the comments. And that's it for today.
Hit the like button and subscribe to Market Reflect. Stay tuned for more and catch you at the next one.